Well, for more on the Fed decision, I'm joined by Mike Archbold. He's the former CEO of GNC and a trustee for the Committee for Economic Development. Welcome to the show.
Thanks for having me, Rachelle.
So as we know now, the Fed will stay this course of having its 3 interest rate hikes for 2018. What's your take on the pace of these increases?
So the pace of the increases has really been driven a lot by the background. We're in a situation, for whatever reason, we had a financial crisis a number of years ago, and the economy has been performing well since then, recovering from that. We're now in a situation where the economy is growing at a nice clip. The unemployment rate is at very low levels, in fact, close to or at full employment levels, and inflation is under control. So this was a very opportunistic time for the Fed to continue to increase the Fed funds rate. I think it's also important to note it's rather pragmatic for them to do so because if somewhere down the road there were a need for the Fed to need to be more accommodative, this would give them some proverbial dry powder to be able to do that.
And to give context, I mean, rates still are incredibly low at the moment. But how do you think these increases and those planned for 2019 and 2020 will impact the economy?
So yes, you're right. These rates are still at historic lows. They're at the lowest rates they've really been in my lifetime and in many people's lifetime. So it's interesting to see the pace of the expected interest rate increases, 3 this year, and the expectation of another 3 next year. But I think it's important to keep in mind, as Chairman Powell pointed out today, the only real decision that came out of today's meeting was to increase that Fed funds rate target. Everything else was really a forecast, which is subject to revision down the road. And I think that the Fed is trying to thread the needle to make sure they get the right balance, the Goldilocks effect, if you will, of making sure that they can grow the economy, keep employment in check, and keep the interest rates appropriate.
Now, for people who are wondering how today's announcements affect them, whether it's industries or borrowers or consumers, what should they be taking away from this?
Well, some interest rates will go up, so consumers who have variable rate notes or are looking to borrow, there will be some increases in interest rates associated with that. But the flip side is you can take some solace in knowing that the Fed has taken the position that we have good growth and we can afford to be doing these things. And I think the Fed is also not only looking at the historical growth, but also seeing that there is additional stimulus coming from a combination of the tax package that has been passed, as well as the deregulation efforts that are underway.
And we certainly saw a very optimistic tone from the Fed about the economy, despite some of the slowdown that we saw in the first quarter. So how would you say the U.S. economy is performing overall as we head into the second quarter?
I'd say the U.S. economy is performing well. We've got reasonable growth. We have near or at full employment levels. We have inflation under control, and we've got a number of stimulative effects that are coming down the road. So I think this bodes well for the potential for future growth for the United States, which bodes well for all consumers in the U.S. and, frankly, the world economy.
Now, something that we have seen the Fed try and keep an eye on is obviously their 2% inflation rate target, as well as what we're seeing with wage growth. Are there any economic headwinds that you foresee in the coming months?
Not just foreseeing economic headwinds, in fact, really seeing more tailwinds from a lot of the stimulative effect that is coming our way.
But what about inflation? Do we know how the Fed plans to address what it wants to do with its inflation target? How much is tolerable?
So they were a little evasive on that. They have the target of 2%, which is below 2%. So they certainly have some room for it to be able to grow. And in the meanwhile, I think the expectation is that they will continue to ratchet up rates to the extent that they can and be accommodative if they need to. But I think from where they're sitting right now, the feeling is that inflation is not going to be the problem. It hasn't been, even with the dramatic declines that we've had in unemployment rates from as high as 10% in 2010, now down to 4.1%. We haven't seen that really resulting in any significant inflationary pressures.
Now, from a leadership perspective, we saw that heading the Fed, we have Yellen out and Powell in. And then you also have Trump's top economic advisor, Gary Cohn, resigning, with Gary Kudlow then appointed to replace him. What should we read into that in terms of where the economy or perhaps the policies could potentially be heading?
So I think there's a couple of things. There's been a lot written about Gary Cohn being out and Larry Kudlow being in. Larry Kudlow continues to also be a free market proponent. So I think we can expect to see him continuing to do that. I think that we will continue to watch to see how the administration plays out its economic plan. But on the flip side, the Fed has really been very cautious about making sure that they protect their independence and therefore don't cross over into the administration side. And therefore they've been very cautious in making sure they play their base, if you will, and sticking to the monetary policy. And I think that the new Chairman Powell has really threaded that needle very well today. I think he was also very good at being plain spoken, really talking about the fact that so much of the discussion has been about forecasts that can change and be subject to change. And really that in fact, the only thing that really happened today, the only decision that was taken was to raise that Fed funds rate by 25 basis points.
All right, thank you so much. Mike Archbold, the former CEO of GNC and the trustee for the Committee for Economic Development.